Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and tonight I have my experts look at stocks that I'm being continually asked about. Pushpay, Appen, Double Catapult, Treasury Wine Estates and Megaport. Shaw's Adam Dawes will give the broker's view, and then I'll get the founder of Megaport, Bevan Slattery, one of the best tech entrepreneurs in the country, to explain what Megaport actually does. And then Julia Lee will look at a number of these stocks for a second opinion, and I'll ask her about Megaport as well. And then Paul Rickard will look at the Switzer Higher Yield Fund that is currently looking for investors ahead of a listing on December 24. We'll then meet Chris Joy's lieutenant, Ying Yi An Cheng at Coolabah Capital Investments, who combined, along with their huge team of experts, will manage the fund. And finally, Michael Gable from Fairmont Equities will look at what the charts are saying about many of these companies I've analysed on the show already. Which one will be his best pick? So without any further ado, let's cross to Adam Dawes from Shaw & Partners. Well, Adam, another day when the market's gone up. Do you think this market's going to keep on rising into 2021?
Yeah, I don't know. To be honest, it's looking like we've had our Santa rally. November was a fantastic month for our market. I sort of struggle to see how we will continue to keep this momentum moving. However, I will say commodity prices are moving higher, which means earnings per share will move higher, which means our commodity stocks will move higher. And so potentially we will hold this 6,600, 6,800 until Christmas.
Yep. Okay. Let's look at the stocks I asked you to have a look at. And these are stocks that people are asking me about all the time. So let's start with Catapult Group International. What do you think?
So going through COVID, this thing potentially was going to be very, very tough. Basically, no one's playing any sport. So, these guys were going to struggle. I think what they've done is they've done very well in lowering costs. They've got a strong balance sheet and they can illustrate some resilience. However, I think 2021 is going to be a tough year for them. I think this is a 2022 story. I still like it, but the return to growth will definitely come in 2022. So this one is probably a hold from me. I'd probably sit back and watch this one over the next 6 months to a year, see how they go. They do have a good balance sheet, but yeah, I think they will struggle as things come back to normal. But definitely 2022, it's a buy.
Okay, let's go to Pushpay now.
Yeah, Pushpay, again, this is one that actually surprised a lot of people through COVID because obviously it's a payment system that looks after software for churches, and those kinds of things, and customer donations and things like that. I think this one is a hold again for me. It has come under some selling pressure over the last coming couple of days and even over the last month, moving sideways. I think Pushpay will be able to build that community of churches, especially in the US, and continue. But there's more things that these guys can do. It's not just churches. It's so many other things that are getting donations. So I'm quite positive on this one. The stock definitely looks like it's in a sideways pattern. So just be a little bit careful here. And I'd like to see some upgrades from the company before I'd start to buy in to these ones.
Yeah, you can imagine football teams and those community groups could easily get into using the services of Pushpay because they're always looking for money and people are interested in supporting them, but it becomes a little bit too hard sometimes.
I agree. And look, technology is moving forward at such a rapid pace that these things will do well. And it's certainly, the clip of the ticket is where they're making the cash. So, yeah, it's an interesting one. I like the story, though.
Okay, what about Appen?
Yeah, look, one of our favourites really in the tech space and has done very well. I mean, there's a lot of companies or a lot of research houses that are upgrading these guys at the moment to outperform or even a sector perform. The US technology customers sort of seems to be rebounding at the moment, and advertising revenue seems to be moving through as well. I expect that their results are going to see a re-acceleration of search advertising and revenue, and they've got their largest customers being Facebook, Microsoft, Google, Amazon, all of these kinds of things, which represents around about 80% of their revenue. So I don't think that's going away. I think it's a buy. I'm always happy to buy this on weakness. A lot of analysts have sort of upgraded their targets and increased their price target. I'd like to see this around $40 before I'd even potentially put a hold on it. So I think, yeah, this one's a screamer and it looks good.
Dubber Corp.
Well, you're getting the hard ones to me today, Peter. Definitely. Dubber, look, I saw this at 20 cents and didn't really like it. Maybe because I didn't understand the business, and that's probably my fault for not understanding it. But Dubber's a fantastic business because certainly when you ring a telco and then you ask for your recording back because potentially there's been an issue, it can take up to 7 weeks to get that recording back. Dubber is a business that has that technology solution that's a scaled, cloud-based call recording system that can basically get that back within 5 hours or even 3 hours. You can get that recording back straight away. They've had some really good contract wins with Telstra, and then they've got some fantastic business with AT&T, Cisco, IBM, and those kinds of things. They do a service as a software package. So every time they add a new customer on, it's just pure profit. I think it's a buy, and it's a really good story. We like it here at Shores, and we've got a buy on it as well.
Okay, let's go finally to Megaport. Had a good day today. And I should say to you, after you, I'm actually showing an interview I did with Bevan Slattery, who probably knows a little bit more about Megaport than you. But what are the brokers?
Okay. I'll take that.
So what are the brokers saying?
Oh, look, Megaport's a fantastic business, and it has come under it has been sort of moving sideways, and the pattern has been moving sideways, but I really like this business. Bevan Slattery, obviously one of the major founders of this business, and has done very, very, very well out of it. But the whole idea of connecting people to the cloud in the old days could take up to 3 months. Megaport can do it in 30 seconds. So that's their competitive advantage, and I suspect that they will continue to do that. We really like it. I like it at $14, $15, $16. I think it's a buy. They certainly will accelerate that business going forward into 2021. So, yeah, I can't say enough good things about it, about that one, Peter.
Okay, well, I'm glad I picked out some stellar stocks for you to comment about.
It's always the hard ones when you on a Monday afternoon, that's for sure.
Adam Dawes, thanks for joining us, mate.
Thank you. Have a great day.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Same with in Megaport land. Megaport started 7 years ago. We're in all these countries. We're in all the markets that every other incumbent around the world is almost in. But what we did is that we did that in a independent fashion everywhere. We encouraged all the carriers, all the enterprises to interconnect to cloud, and we saw that opportunity. And because we are neutral and independent, we're able to win that market space. And that's where we are today. And I think we do more interconnection to cloud at Megaport, I think, than any. I'm pretty sure that any carrier in the world does.
Okay, talk to us about Megaport, because a lot of experts on my investing show have liked it. And I've fallen into it. Because my experts, I provide them for other investors, and occasionally they get me in as well. I'm in. So, but for people who don't understand Megaport, what does it essentially do that's so unique?
Yeah, so its greatest value proposition is we did the connectivity what Amazon did to compute. Okay, and so what does that mean? So what Amazon did is that they really brought the cloud to enterprises where a company can just rent compute capacity on demand, dial it up, dial it down, do it themselves without talking to anyone, signing an order form, doing whatever. So this Amazon juggernaut was happening. This cloud's coming in. Enterprise want to connect to it. The problem is that the cloud didn't live in every data center. All these enterprises needed to get to these, what they call cloud on-ramps, and they lived in very few data centers in a country. So we realized this early, and we said, hey, let's create a platform that allows anyone in, for example, we're in about 50, 60 data centers in Australia. It doesn't matter where Amazon or Microsoft Azure sits or Google Compute sits or Oracle Compute sits. Just get a port on the Megaport platform in whichever data center that you're in, and we'll manage that connectivity to all the different cloud providers over that one single port. And again, you can do it in a web portal using the application. You can sit there and go, I want to connect my network, my enterprise network, into my infrastructure sitting on Amazon. I want to connect it now at 5,000 megabits per second. Go. And it happens within a minute. And so what we did is we virtualized the whole connectivity experience from whatever data center, now there's 700 data centers or so around the world, into any one of the major cloud on-ramps anywhere in the world.
So does that mean that you don't have to lock into a contract for a set period of time where you might not use much of it? It's basically, when you want it, you can basically access it and pay for it.
Completely on demand. 100% on demand. You can do a connection for as little as a minute for as long as a year. And you can dial it up and dial it down. You know, you're Victoria Racing and you've got the Melbourne Cup on this week. You need a lot of compute, and you go order that from Amazon, and then you can order 10,000 megabits of connectivity for 1 week from Megaport. And then as soon as the spring carnival's over, you turn it straight back down again. It's that simple.
That's a great example. So I guess businesses would do it over the Christmas shopping period, Black Friday.
Absolutely. 100%. Yeah, and COVID, we saw when COVID, first came on, and enterprises said, we've got to move out of the office. The amount of traffic we saw come on the network, and the amount of new interconnections made into different cloud operators was massive in March. It was huge.
Megaport's rivals, are there many businesses doing what you guys are doing at this point in time?
No, certainly we're the leaders in it. There's a few people kind of coming up, but we had about a 4-year head start of scale. I always say to people, we were so far ahead. The analogy I would give people is like it's kind of like when you think it's going to be a great day at the surf, and you're surfing out and the big waves are coming, and you're out there all alone. You kind of think, are the waves coming? Is the big wave coming? You start not being sure, but when it does come, you're there and you're set. So we were certainly out there, far and early ahead of everyone, and which is why we've got over 2,000 clients on the platform today.
Well, as we do, we catch up with Julia Lee every week, and I've got her coming on after Bevan Slattery, who happens to know a little bit about Megaport. And I know in the past Julia has shown a bit of interest in the company. So Julia, thanks for joining us.
Great to be here, Pete.
Julia, what's your view on Megaport right now?
Well, Pete, I like Megaport as a business. Megaport is something that allows customers to be able to transfer data to the cloud, but also from data center to data center. So if you have a look at the long-term view, the demand for services like this are only going to increase. Having said that, though, we've seen the share price coming under pressure because we have seen this great rotation away from growth into value. And so I like to see shares improving and moving upwards at the same time that earnings are also improving. So with Megaport, I've just been waiting for that inflection point to happen.
So it's like you'd like to hold it for the long term, but you think in the short term it might not just show you the kind of upside that many people would expect your tips to do.
Yeah, I mean, the great rotation has meant that a lot of these technology companies, which are still growing very strongly, have seen its share price falling 20 to 30% in price. And I know from academic studies that you get a much stronger signal when share prices as well as earnings growth are moving in the same direction. So usually I'm not a buyer of falling knives or falling trends. I wait for that inflection point before getting in.
Okay, you make sure you tell us when the inflection point happens, Julia.
I will.
Okay, let's go to this. Now, I tossed some unusual ones at you, but this is not. Treasury Wine Estates. A lot of people are saying to me, well, if I'm a long-term player for Treasury Wine and it's around $9 or so, why wouldn't I buy it and just wait for the Chinese to forgive Treasury Wine Estates?
So I find this one really hard, Pete, because this is not about the business case for Treasury Wine Estates. This is all about the political relationship. And I find it hard to try and predict what the political relationship is going to be like in 9 months' time, whether it's going to be better or worse. So for me, this is really a binary outcome. Treasury Wine Estates at the moment has a 169% tariff, which is being charged by China. China has said that the tariffs are only for 6 to 9 months. So obviously, if the relationship with Australia and China does improve, then we'll probably see those tariffs disappearing off into the horizon. However, I do think there will be short-term impacts. I'm a great drinker of wine and lover of wine. And look, wines are made either to drink now or you can drink them later on. So a big portion of the market, so if we look at Treasury Wine Estates, its inventory is worth about $2 billion. $1.3 billion of that is the luxury market, brands like Penfolds, which you can store for a while and not a problem. But that means about 700 million is really made to drink now. So I think there are going to be significant write-downs here, probably $100 to $200 million. That's incorporated in the price. But for me, I can't make a decision on Treasury Wine Estates because this really is a binary outcome. Either, the relationship with China gets better or it doesn't. And I noticed a report out today that China is saying that maybe COVID-19 originated from Australian steaks or Australian beef. So at the moment, the relationship seems pretty hot.
Yeah, okay. So it's for the punter at this point in time. All right, let's go to PushPay. What do you think?
Yeah, look, PushPay has been one of these companies that has been growing so strongly, and really they look at the electronic means for, people that go to church to make a donation to the church. And they've been signing up these mega churches, which means that once they sign up these mega churches, there's a massive jump in terms of revenue. The problem is they've pretty much saturated the mega church market over in the US, so they're now going to have to move to targeting large to medium-sized churches, which means that big jump up in revenue is no longer going to occur. So look, it's probably got a slower growth trajectory ahead of it. So for that reason, I'd probably be staying away from this one, or even tempted to take some money off the table if I had some of this stock.
Okay. How about Catapult?
Catapult's one of these companies. It's these bands that these elite athletes wear to monitor their heart rate, as well as some of the statistics around performance. And we know that 2020 has been a really weird year for events, including sporting events. So that's sort of thrown a bit of a spanner in the works. 2021, we probably are going to see a bit of recovery there from the COVID-19 situation. But really, in terms of the underlying business, there's no huge catalysts here. So for me, I'd say it's just steady as she goes and just waiting for that COVID-19 recovery to take place.
Okay. Live Tiles. What do you think?
So Live Tiles is a company that targets other companies with more than 500 employees, and that's because its bread and butter has been intranets. If you've worked in a large organisation with multiple offices across different states and different countries, then it becomes important to communicate to the whole workforce around strategy, movements in terms of personnel, meetings, important dates, and this is what Live Tiles mainly does. It has a strong partnership with Microsoft, which means that's one of the key risks as well. But having said that, if we have a look at Live Tiles, there has been a problem in terms of conversion. I think what Live Tiles does is it gives its potential customers a 6-month free trial, and then it tries to convert that into actual customers. And there's been a slower conversion. I'm not sure if that's because of COVID-19, given that so much of their sales does occur over in the US. So look, I'd be keeping an eye on this one. At the moment, it looks like it's slowly creeping upwards, but really I want to just have a look at the next half-year numbers to get a bit more confidence around the story, because the last half-year set of numbers was relatively weak, I think, from the customer acquisition and conversion point of view.
Okay, one final one. I've noticed in recent weeks you've become a bit of a mining girl. So what do you think about Jupiter Mines?
So Dividend Mines, at the moment, it's looking at spinning off its iron ore assets into an IPO, which means that it will be just a manganese company. And when you look at manganese, it's primarily used in steel production. So 90% of manganese over in China is used for steel, and then the other 10% is used in batteries and chemicals. It's quite interesting because the last Tesla Day, they did indicate that they may be moving away from the lithium nickel type of batteries more into using manganese. I think that's because manganese is much cheaper and readily available, which means that it's pretty easy to get your hands on. So I would prefer playing the electric vehicle stories through something like Linus, which we're a holder of. Or if you're looking at that resource story, I do think that governments around the globe are going to be building infrastructure to try and grow themselves out of recession. I think that's great news for iron ore stocks, steel stocks, and we're great fans of Sims Group as well as SGM, as well as Mineral Resources at the moment.
Okay, great stuff, Julia. I know it was a speed dating exercise tonight, but we had a lot of stocks to get through. Thanks for joining us, and Julia Lee is from Berman Invest.
Pleasure.
Right now, the Switzer Higher Yield Fund is open for people to participate, and it will actually go live at the exchange on December 23. And I've had Paul Rickard look at the details of this too, so people can understand what this is all about. Paul, in a nutshell, why would people participate in something like this rather than waiting for it to go onto the stock market?
Well, there's certain reasons to participate now, mainly because it's paying you a bit of a bonus to do so.
Okay.
I guess, Peter, at the outset, we should just disclose our conflicts. We are shareholders in the responsible entity, and we've got a few other associations. So just get that out of the way first.
Yeah. And with the name Switzer, I can't avoid association.
Yeah, you probably can't. Maybe mine's not always as clear.
You're an honorary Switzer. Go on.
Okay, so let's move off on that. But the reason to participate now, Peter, is that if you do so, and you have until the Friday the 18th of December to participate, then there's actually going to be a bonus of about 0.5% paid to investors, providing they hold their units for 12 months. So effectively add about 0.5% to the return over the next 12 months.
Okay. It's called the Switzer Higher Yield Fund. Do people think of it as being a bond fund? Is that a fair term?
It's fair. It's a short duration bond fund. When we talk short duration, Peter, it's not going to take a lot of interest rate risk, and it's not actually going to take a lot of credit risk. Actually, with the
so it's two problems of bond funds.
Yeah, and that could be the issue about investing, particularly when interest rates are so low, because we know that if long bond rates go up, the capital price of bonds can actually go down. They have an inverse relationship.
Right.
And also, a lot of bond funds take a lot of credit risk. They invest in quite risky securities to get the return.
Yeah.
And sometimes that doesn't work out as well. So this is a fund that's going to invest it's got short duration, pretty low credit risk. Most of the investments are going to be investment grade. And then through the skill of the manager, that's Chris Joy from Coolabah Investments, you look for opportunities to identify mispriced securities and mispriced assets. So it's really about the skill of anything of the investment manager.
Yeah.
It's not targeting that big a return, Peter. We're talking about a target return of the Reserve Bank of Australia cash rate. That's currently just 0.1%.
Yes.
And add on about 1.5% to 3%. It'll vary over time.
Yeah.
So something around about for the next 12 months, 1.6 to 3.1%.
Yeah.
And then if you invest, the next 12 months, you get extra 0.5%. So that's what gets the return to potentially over 2% for the next 12 months.
And so I guess if the economy really has a big surge in 2021, the Reserve Bank won't raise interest rates, I don't think, in 2021, but in 2022 they could, couldn't they? If the economy is really rocking.
They could. They've said they're not going to raise the short-term rate for 3 years, but if the economy rocks along, then they'll at some stage be forced to raise the cash rate, and a fund like this should do better with a higher cash rate. That's simply because the holding return on all the assets it's owned will also go up, so the sort of cash rate sets the floor. So I would position this for a lot of investors as a bit like the old money market fund, right? This is not a term deposit. There's no guarantee here.
Yep.
Things could go wrong, although it's investing in securities of pretty low credit risk. But let's not say that it's riskless. It's not a riskless investment. But it's a bit like a money market fund. It'll give you that type of return. The manager is going to add value. It should have really good liquidity, Peter, because it's listed on the exchange. The responsible entity is employing a market maker, so that means that the price it trades on the exchange should be very, very close to its real unit price. They'll publish the unit price in real time, so you can go to the screen and you find out exactly what it should be worth. And it's also got some other mechanisms to help it do. So
people can get in and get out fairly quickly.
Yeah, it's listed on the exchange. T+2 settlement date. You get a CHESS holding statement. You need your money back. You just sell it on market. So it should be. It's why I liken to a bit. Go back 10, 15 years ago, we had money market funds. It's a bit like that, but it's just that's not a fair description. But I think investors can perhaps sort of picture it in that sort of form.
Okay. What are the pros and cons of a fund like this, do you think?
Well, look, let's start with the cons. I think it's always worthwhile stating what's against a fund like this. Obviously, it's not a term deposit. It's not government guaranteed. We do depend on the manager of the Coolabah team. That's Chris Joy and the other
Ying and Chang, who's a very impressive performer.
Yeah, who you interviewed later in the program.
Yeah.
So it does depend on their skill set really to generate any outsized return. So that's probably the.
And the track record's been pretty good, hasn't it?
The track record of Coolabah is pretty good. They've got $4.5 billion in funds under management. They are just specialist fixed income. That's all they do.
Yeah.
And Chris will tell you that, and Ying Yi.
And Chang
also says that.
Yeah.
So and she's looked like a very talented fund manager. Yeah. So they're probably the negatives. The positives, Peter, obviously a return much higher than term deposits, but that means you're also taking on
more
some
risk. Yeah.
Right? Should be pretty good liquidity. Term deposits you can't break, right? Well, you can only break with a big penalty.
Yeah.
So this has got good liquidity on the stock exchange. You just go to your online trading platform or your broker. You can sell your units if you need your money back. I mentioned the bonus interest rate for the first 12
So
months.
if Chris gets 3.1 maybe, you add another half on because you hold it for 12 months.
Yep, and it's called a loyalty bonus, and so it does require you to continue to hold those units right throughout the 12 months.
Yeah.
But that's a pretty positive return. And as I said, it's up the risk curve, but it's relatively low risk in sort of in bond fund standards.
And the fact that it floats a floating rate, that means if interest rates rise, it will benefit from it.
Yes, and we probably know we're at the bottom of the cycle. And the Reserve Bank governor said he's going to keep them at this level for 3 years and not increase them. Well, you and I both hope he's
wrong.
Wrong. We weren't going to say telling a lie, but we'll be forced to change his words at some stage.
Yeah.
But if interest rate rise, this will float, and therefore the return on this should also go up. So it's effectively a floating rate investment.
One final question, Paul. If someone's interested, how do they participate?
Go to Switzer Asset Management, that's all one word, switzerassetmanagement.com.au. Download a copy of the prospectus. Always read these documents, they're really important to understand what you're investing in. And if you do by the 18th of December, which is Friday week, then you'll be eligible for the loyalty bonus.
Yeah, I also noticed on Google that the first Switzer Asset Management is the old fund. The one below it is the one that we're talking about.
This is the Switzer Higher Yield Fund, that's right, Peter.
Higher Yield Fund, exactly right. Okay. Well, thanks very much, Paul, for explaining it to normal people. I hope people have a look at this, and if it suits them, I hope they go for it. Now, one business that really is mindful of where interest rates is going is Coolabah Capital Investments, founded by Chris Joy, and his portfolio management director is Ying Yi Ann Cheng, and she joins us right now because these people figure out interest rates all the time, and we'd like to know what they think is going to happen in the future. Thanks for coming on the program, Ying Yi Ann.
Thanks, Peter.
All right, so let's just cut to the chase to explain to people what you guys do and then why interest rates and where they're heading is critically important.
Well, firstly, Coolabah is an active fixed income manager. So we are actually quite different to typical fixed income managers, but What we're essentially doing is we are focused on driving returns in fixed income through capital gains rather than yield. So in our asset class, fixed income, typically if you want more return, you can drive it through taking on more interest rate duration risk, a fixed rate risk, or you can take on more credit default risk, which will compensate you for, investing in securities that would be, for example, sub-investment grade or unrated securities. Or you could take on more illiquidity risk to drive returns. So investing in, for example, illiquid credit or illiquid loans, etc., and other sort of illiquid securities. For us, we're focused on highly liquid, very high grade securities, typically A to AA rated securities with very little or zero intrinsic credit default risk, because the entities that we're focused on are typically those that are either implicitly or explicitly government guaranteed. So some examples, Peter, would be, the major banks and, other strong oligopolies such as, Woolworths, Coles, Optus. And in order to drive returns through capital gains, though, you need to exploit bond mispricings. In order to find these sort of mispricings, you need a very large team. So we're quite a different beast in the sense that we have a very large team by Aussie fixed income standards. So we have 5 portfolio managers, 13 analysts, we have 25 full-time execs, we have 10 quants, we have 5 data scientists, 4 PhDs, 2 university medalists, and so a very strong intellectual edge. And what the team have done is they're looking at bond mispricings that occur that give rise to capital gains. And it's a very simple concept, but very hard and very intense to identify these mispricings. But essentially, a bond mispricing itself is simply a bond that's just paying too much interest after you adjust for its risk factors. So, the industry, the issue size, where it sits in the capital structure, the liquidity. And if that bond's traded interest rate then drops towards fair value, we then sell it for a capital gain. Much like your active equities manager and much like, what a lot of your listeners and audience would be familiar with.
Yeah, and so I guess a classic example would have been when everybody was panicking with the coronavirus crash of the market, there must have been great opportunities where you said the market is overreacting, they're mispricing, and there's really good bonds there that have been mispriced. We'll buy them, and when they spike up, we'll make money. Is that right?
That's right. So in March, we spent $1 billion buying assets. In March, and we've been taking profit along the way. But what were we actually buying in March? So we were buying high grade liquid assets. So we were buying senior bonds issued by the major banks. So that formed about 70 to 80% of our portfolio earlier this year. And major bank senior, just for example, spreads on major bank senior bonds on a 5-year bond blew out from 80 basis points, around 75 to 80 basis points over the bank bill swap rate, so that's 0.75 or 0.8%, to about 175 basis points, so 1.75% over the bank bill swap rate. Now they're trading around 25 basis points. So that spread, that interest rate spread margin has blown out to from 0.8% to 1.75%, and now it's at 0.25%, which has meant that we've captured significant capital gain. We've taken profit before it got to 25 basis points as well. Yep. We've been taking profit along the way. But again, it's senior bonds issued by the major banks. So the mean reversion that took place, or that spread compression, took place very, very quickly. And that's because of, RBA QE, which we were anticipating because we formed the view in February that central banks around the world, including the RBA, would be forced to do massive QE in response to COVID.
Yep, and it's exactly what Chris was writing about in the AFR and other publications where he writes. Now, so therefore we've established the point that it's really important for you guys to have a handle on where you think interest rates are going, because that gives you a chance to work out whether something is priced well or mispriced. So we know there's a promise out there. My viewers are watching this. They're wondering. They've heard the Reserve Bank say or imply that interest rates will be with a cash rate of 0.1% for 3 years. Now, as an economist, I think, well, I know he'll have to break that promise if the economy really roars back in 2021 and it gets even stronger in 2022. He'll have to say, sorry guys, I meant it at the time, but things have changed. What are you guys thinking at this point in time? Do you suspect that the cash rate will be higher in 3 years' time?
Okay, let me first clarify first. So in our portfolios, we aren't making any active bets on interest rate duration or on a view where interest rates will go. However, as you understand and as you mentioned, interest rates and the macro economy is incredibly important in terms of understanding where we would like to be positioned. Yeah. So we're not making any active bets on interest rate duration, but macro is incredibly important. So that macro decisioning, we have a chief macro strategist, and we also have, like Chris Joy, who used to also work at the RBA once as well. So that's a key driver of a lot of the credits, I would say, that form part of our portfolio. With respect to your question around, will rates be higher in 3 years or so? Look, it's always possible. And particularly, given the amount of stimulus that we're seeing, strong stimulus from, both the Commonwealth government and more recently the states. We're seeing, the RBA prepared to do, whatever it takes. So they've announced $100 billion government bond purchasing program over the next 6 months. So they announced that earlier in November, but it looks like that they would be easily, very open to extending that. So given that, and then given a vaccine comes about, and it looks like we have 3 vaccines, on sort of potential to come into production quite soon. It is possible. However, you need to think about it from the RBA's perspective. So firstly, even before COVID, but since the GFC, inflation and unemployment have been undershooting for so many years. And it's quite hard to see a risk of unemployment being too low. The unemployment rate is currently 7%, and also inflation being too high. Obviously, we are still seeing stimulus, and obviously that has expansionary effects for inflation. But the inclination would be, at least for the RBA, to keep things where they are, possibly, definitely over the next 3 years. I should say likely rather than definitely. But I think that they would rather see, inflation overshooting before they actually start to do something about it. Because we've undershot for so long, they're willing to sort of look through. Yeah. And then I suppose, given where we are right now, even if growth is strong, say in 2021, 2022, we still need to make up for the loss of spending pre-virus, and we need to get back onto that same growth path, which will take even longer. So I think the inflation cycle is likely to emerge in the next 5 to 10 years in reality. So at which point the RBA will probably, once we do start seeing those inflation overshoots, and it looks like a bit more of a trend, then the RBA is more likely to act. But for now, I think, the driving forces are locking in a low inflation rate at the moment. Obviously, wage inflation is low, rents are quite low as well. So it's hard to see price pressures, at least, for the foreseeable future in the next 3 years. And obviously the RBA has also made an explicit commitment that they won't, hike rates for them. So I suppose the only way to get that inflationary pressure would be if we start seeing, wage inflation or commodity price inflation. But central banks, including the RBA, want to see ongoing inflation before they likely act.
Great answer. Even though you don't agree with me, it's a great. That was a good alternative answer. And I think you're right. Like if the inflation doesn't come through, they will not raise interest rates. It will ultimately depend on how much growth we get, and that vaccine story is going to be very important. So Ying Yi, thanks for joining us. I should say to people who are listening that you guys have a whole range of different sorts of bond products that people can invest in, and people can check it out at coolabahcapital.com. Thanks for joining us.
Thanks, Peter.
Michael Gable is our charts guy. He's from Fairmont Equities, and whenever we have a question around a company or where the market's going, we like to see what his charts are telling him and then what they can tell us. Michael, thanks for coming on the program.
Thanks, Peter.
Good to see you, mate. Let's just, before I look at 4 stocks that I've asked you to look at, Catapult, Pushpay, App, and Double Corp. What are you seeing in terms of the overall market? 'Cause I know you watch the ASX 200, you watch the S&P 500, NASDAQ and whatever. Is there more upside for this market?
I think so, yeah. So at the moment...
And you were right. You know, last time I had you on the program, that's great. And the time before that, you were right. So we're... Yeah. And it's reinforced my view on the matter, so it's great. But so what are you seeing now?
Yeah, look, the market still looks good. Looks like it wants to head higher. Just looks like we're going to have that rally through to Christmas and beyond. I mean, our market, as we've touched on a number of times, had a narrow trading range that it broke out of just after the US election, and that should see it continue to head higher. US markets did stall for a few months there, and if we look at, for example, the NASDAQ, which had a horrible day about a month ago, and everyone was talking about rotation out of that into value. I mean, that's broken to a new high in the last several days and is starting to edge higher again. So US markets look like they want to head higher. Our market looks like it wants to head higher. So I'm still bullish on materials, energy, global cyclicals, travel stocks. I think they can all continue to do well, and so far so good, Peter.
Yeah. And we should make the point that, Michael might correct me, but he's not driven by a value judgment. It's the charts first, isn't it? And then you see whether the other kinds of analysis are consistent with what the charts are telling you.
Well, we do blend both the fundamentals and the technicals. So the charts are very important. In terms of stocks I buy, they need to be fundamentally sound, but we do have a look at the macro environment as well. I mean, there's no point, I guess, going after a particular sector or a market when the time's just not right to do so.
I like two-handed analysts, mate, so it's good. Let's go to your first one. And a lot of people have been asking us on our various television programs. Catapult, what are you seeing there?
Yeah. Now, with this particular chart at the moment, look, it's telling me we don't have to rush into this particular stock. So what I've noticed here is, sure, it did peak in early September. It has been coming back. Everyone could see that. And the broader market's been heading higher during that period of time. So look, it's undertaking a period of underperformance. So I don't think we need to rush. If we have a look at the left of that chart, we could see that initially it had peaked sort of late last year, early this year. And when it ran higher in September, it did manage to get to a new high, but the selling kicked in. So it just tells me it's not ready to be trading up at those levels. So I think this is one where investors could probably get it a bit cheaper. Yeah,
okay. Let's go to the next one. This is pretty popular in the news, Pushpay, PPH.
Now, this one, clearly in a range here, we can see that although at the end of October, it went back to those July highs and failed, at the end of November, it managed to hold on to that September low. So quite clearly, there's a channel there. It's at the bottom of that channel. Now that means if you like the company, pretty much this is your opportunity, your first opportunity to buy because it's at the bottom of the range. However, the chartist and the trader in me would say, I'd be happy to buy here. However, if it broke that bottom blue line, I'd just be quickly out of it. Yeah. Because everyone has their stops at that level. So if you see it go through
But will you get set, or you'll probably have to go a lot lower because everyone else is wanting to get out that low?
Yeah, I don't have a crystal ball. So it's one of those things where you know,
You don't have a crystal ball. What have I got you here for?
So it's one of those situations, Peter, where it could break support and maybe it just reverses quickly, but it might break support. There might be a bad announcement. There might be something else happening in the world, and before you know it, it could be all the way back to the low $1 region. So current levels, buying opportunity because it's at the bottom of the range. The next buying opportunity, of course, is if it breaks out to the upside. So the upper blue line there, if you can get above that, then that's where I'd be adding to my position.
Yeah.
If I was
and what we can see that out of March, it's been an extraordinary surge, hasn't it? Way past where it was before the coronavirus. And it just sort of makes you think that all the people who've made lots of money, some of them have taken profit, haven't they? Some of those fund managers have taken profit. And we're waiting to see whether there's a good reason to go any higher.
Yeah,
I guess the
exactly.
company has to provide that reason. Now, this was a former darling of the market, Appen. What's the chart telling you now?
Now, look, this is, I'm familiar with this company. It is a very good business.
Yeah. It's one of the WACs.
Exactly. And this is one that it's worth keeping an eye on to buy at the right time.
Yeah.
Now, the chart in front of us here only goes back just over a year. But for those who are familiar with the company, you'll know that this has been trending higher for many years. So ultimately, at the end of the day, this is still in a long-term uptrend. But shorter term, it is under a bit of pressure. So we had that initial sell-off that was quite sharp in August. It was unable to make much headway. It looked like it was going to improve, but in the last few days, it's broken support. So in terms of these horizontal blue lines, the top one there on the right-hand side, that was the first support level that it's broken under. We can see that there are other support levels fairly close by, near $27, $28. So, if you're looking to buy it, I'd be waiting for evidence of really good support, hopefully around those levels. It remains to be seen. If you're in the stock, I guess it depends. Do you have something better to do with your capital at this point in time? Because Appen clearly isn't going the right direction. Otherwise, if you've got plenty of other dosh sloshing around and you don't need...
Of course, a lot of people watch the show.
Which is plenty of people. Then, and you've got a bit of a longer term horizon, I'd be happy to hold Appen and just wear that short-term downside because, as I said, longer term, it's still in an uptrend.
Yeah, that's a good point. Let's go to the final one, Dubbo Corp. This looks a lot more positive than anything I've seen today.
Yeah, so unlike the Catapult, the first chart that we saw, since September, this one's actually kicked on quite nicely. So it's outperformed the market. It's heading the right way. Early warning signs when I look at it. So what I'm looking at is in the last few days, it's shot up towards $1.90 and then come back down. Now that's significant because if we move all the way to the left-hand side of this chart, the old high back there in October was around that sort of $1.70, $1.80. So what this stock has done is it's gone to a new high. Great. I'm happy to buy stocks when they go to a new high because usually they continue on. This one hasn't continued on though. So instead of everyone else sort of rushing in to buy it, a lot of investors have been hitting the sell button. So this is just telling me that it's not ready to be trading up there. It'll probably consolidate back to that mid $1 region, maybe $1.50, $1.60 potentially, and then it'd be ready to get going. So just some short-term weakness there. But overall, as we could see since the March lows, it's performed pretty well.
Yeah, and look, when you look at the kind of reasons why there would be profit takers, after the 10% rise in November, the US has some challenges at the moment, second wave infection. I'm sure a lot of people are thinking, well, we are actually strong enough to go higher, but the Wall Street example could really go against us. And so there'll be a lot of people taking profit, but there's going to be a buying opportunity for some of these stocks that we showed tonight. Yeah,
for sure. I think, I still think our market, as I said, is higher to run. There's a lot of stimulus out there. Share markets do the best when they come out of a recession. So a lot of people have to remember, I know we say it all the time, but markets are forward-looking. We're not concentrated on the problems today, but the improvements potentially ahead of us. And sure, sometimes they run ahead of themselves, but there's a lot of companies out there that maybe they have run ahead of themselves. Dubbo could be an example of one that was probably more than fully valued. And But then there's also other companies out there which are just haven't realised all their potential.
And Michael, our final one, a lot of people have been asking a lot of questions about this company, Megaport. What are the charts saying?
Now, this one, in some ways, is similar to Catapult as well, where since the September high, it's gone backwards and the broader market has headed higher. So when I look at the trend, I look at the previous lows as, I guess, the line in the sand. For an uptrend, it needs to respect those lows. You need the higher lows. So that horizontal blue line that we could see there on the right-hand side is where that previous low was. And what Megaport's done is it's gone back to that line, marginally broken under it. So it's at the level where it really does need to rally here. When I look at the way it's traded since the September high, though, there seems to be more conviction in the selling in this stock. So it falls very quickly, and then it takes a while for it to try to get back up, and then the sell button gets hit again, and it comes back pretty quickly. So at the moment, to me, it looks weak. Longer term, again, good trend there, but at the moment it looks weak. If it can't hold that line at $13, we'll probably see cheaper levels, and obviously, if you're keen on the company, that'd be a good thing. But I think, at the moment it's at this inflection point.
Okay, you made the point earlier that there was one day when tech stocks got sold off, and a lot of local stocks copped it as well. Do you think Megaport's a bit of a victim of being a tech stock, a darling that has done very well, as you can see from the chart? Look,
potentially. I mean, I'm not familiar with the business, but I think all tech stocks to a varying degree have that hanging over their heads at the moment, ever since we saw that little sell-off in November. So yes, there is a bit of that, but it may well be, we've already seen it, I guess, fairly short-lived in terms of the NASDAQ. For our stocks, we might find them recover pretty quickly. I'm optimistic that they will recover and continue to rally. If we recall back to the US election in 2016, there was a bit of a rotation that lasted 6 months. It just feels as though in this market, everything seems to happen a lot quicker nowadays, and we seem to get over things a lot quicker. One final one, of those companies you've shown me tonight, which one looks the most promising to you? I guess for me, just purely going off the charts, I think PushPay is the one where it just seems to have a better looking charting profile. So it's at a clear support level, seems to have bounced off that. A lot of the others just look a bit weak momentarily. I guess longer term, I'd go for Appen because I'm more familiar with the business. But today, if I had to throw money into something and quite clearly see where the support levels are, where the targets are, for me, it'd be PushPay as a short term. Thanks, Michael. Michael Gable, Femont Equities.